Disclaimer. On September 15th, 2008, the world didn't just break, it was sabotaged. Most people call it the Lehman Brothers bankruptcy. I call it a crime scene that has been scrubbed clean. We saw the panic, we saw the cardboard boxes, and we watched $10 trillion of global wealth evaporate in seconds. But here's the catch. The weapon they used to kill the economy? It wasn't destroyed. This is the Valukas report. 2,200 pages of autopsy notes they tried to bury. But look closer. Volume 3, page 732. Right here, hidden in the redacted lines, is the mechanism. This isn't just history. This document contains the exact blueprint banks are using to rig the system again. Because that same mechanism is running right now inside the commercial real estate market. There's a $1.2 trillion bomb ticking in those empty office towers. You might have survived 2008 by luck. But you will only survive 2026 by preparation. Let's open the file. Welcome to the vault. Here, we don't watch the news. We read the ledger. The talking heads are looking for bad guys. But we are looking for bad mechanics. We are going to ignore the noise and trace the money to see how a system rigged for fraud actually works. We aren't just reading history. We are decoding the warning signs for tomorrow. To understand the threat, you have to understand the scale. $600 billion. It's not just a number on a screen. That is the foundation of the global economy cracking in half. It was the largest bankruptcy filing in human history. It was the largest bankruptcy in history, but to solve the murder, we have to ignore the body and look at the weapon. That weapon was built on a double standard that you deal with every time you apply for a mortgage. When you walk into a bank to buy a house, they demand 20% down. They check your credit, scan your pay stubs, and treat you like a liability. That is 5-to-1 leverage. It's safe. It's boring. But the banks didn't play by those rules. They had access to what I call the infinite credit card. They could borrow billions with almost zero collateral. So why did Lehman Brothers fail? Because while you were being scrutinized for a mortgage, they were running a casino with the lights off. Let's visualize their position. This is the leverage ratio. By the first quarter of 2008, Lehman Brothers was operating at 31-to-1. Imagine a Jenga tower. This single block at the bottom, that is the money Lehman actually owned, their equity. These 30 other blocks stacked on top, that is the money they borrowed to gamble with. For every $1 of their own cash in the vault, they were betting $31 of someone else's money. In the real world, this is insanity. In Wall Street terms, they called it capital efficiency. But looking at this tower, you don't need a PhD in economics to see the problem. You just need eyes. It wasn't a bank anymore. It was a skyscraper built on a toothpick. Here's the fatal math that killed them. When you are leveraged 31-to-1, your margin for error isn't small. It is microscopic. If the value of Lehman's assets dropped by just 3%, that tiny loss would eat through 100% of their equity. They would be insolvent instantly. 3%. That's a bad day on the stock market. That's a rounding error. But in 2008, the housing market didn't just drop 3%, it crashed. The moment real estate prices started sliding, Lehman wasn't just losing money, they were mathematically dead. They were a walking corpse, but they didn't stop eating. They kept buying more. Why would a dying bank keep feasting? Because in 2002, the entire market was starving for yield. The financial world was hungry. Interest rates were sitting at 1%. If you were a pension fund or a retiree, safe government bonds paid you pennies. You couldn't survive on that. Wall Street saw this hunger. They knew investors were desperate for a meal that tasted like a high return but looked safe on the menu. So Lehman Brothers and their peers didn't just sell loans anymore, they became chefs. They invented a new item that turned toxic waste into gold, and they served it to the entire world. This is the mortgage-backed security. But let's strip away the banker jargon. To have mortgage-backed securities explained honestly, you just need to look at this machine. It's a blender. Here's how it worked. They would take one prime stake, a mortgage from a doctor with a perfect credit score. Then they would throw in 10 pieces of rotten meat, loans to people with no income, no job, and no assets. The machine grinds it all together. What comes out the other side isn't a steak anymore. It is a uniform processed meat patty. You can't see the rot. You can't smell the risk. It all looks the same. Then they sliced this patty into layers called tranches. The top slice, they stamped it AAA, as safe as a U.S. Treasury bond. They sold that to your grandmother's pension fund. The bottom slice was toxic waste, but it didn't matter. As long as the housing market went up, the rot stayed hidden inside the wrapper. To understand why this was fatal, imagine a waterfall of cash. When homeowners paid their monthly bills, the water flowed into the top bucket first, the Aurelier bucket. It was supposed to be drought-proof. The risky buckets at the bottom only got water if there was a flood of payments. But Wall Street got greedy. They took the empty, dry buckets from the bottom, threw them back into the grinder, and relabeled them as top buckets in a new machine called a CDO squared. They weren't reducing risk, they were laundering it. They were selling empty buckets and promising they were full. Now the obvious question, where were the inspectors? Why didn't the rating agencies, Moody's and Standard & Poor's, smell the meat? Here's the conflict of interest that broke the world. The banks paid the agencies to rate their products. If Moody's was honest and said, "This smells like garbage," Lehman would just walk down the street to S&P and pay them instead. It wasn't an inspection, it was a transaction. They weren't grading the test, they were selling the A+. And because of that stamp, the entire global financial system swallowed the poison. But every poison needs a chemist, and this kitchen was run by a man they called the Gorilla. Richard Fuld wasn't just the CEO of Lehman Brothers, he was the emperor. He had spent his entire life building the bank into a powerhouse, and that success created a dangerous blind spot. He wasn't incompetent. He was invincible, at least in his own mind. He believed that Lehman was too powerful to fall, and that the rules of gravity didn't apply to his balance sheet. But when the market turned, that confidence didn't look like leadership anymore. It looked like delusion. And that delusion is exactly what prevented him from pulling the parachute. There was a moment where this whole disaster could have been avoided. In early 2008, Warren Buffett, the Oracle of Omaha, offered to invest billions to stabilize the bank. It was a lifeline, but Fuld slapped it away. Why? Because Buffett demanded a good price, and Fuld refused to sell his shares at a discount. He was insulted. He told his lieutenants, "I will hurt them," for shorting his stock. He truly believed the government would never let a bank of this size collapse. He was betting on a bailout that never came. He held out for a premium price, and because of that pride, the stock eventually went to zero. While the ship was taking on water, the captain was looting the cargo hold. Between 2000 and 2007, Richard Fuld took home $484 million in compensation, nearly $500 million. He kept that money. The shareholders wiped out, the employees on the street, the homeowners foreclosed. It brings up the question that makes your blood boil. Was this a reward for performance, or was he cashing out before the crash he helped create? The history books call it a tragedy, but I call it a heist with a golden parachute. But even with filled pockets, Fuld had one problem left, a balance sheet that was about to expose the crime. By mid-2008, Fuld's hubris had backed them into a corner. Every quarter, public companies have to show their report card to the world, the balance sheet. And Lehman's report card was ugly. They were drowning in leverage. If investors saw the real debt numbers, the stock would tank and the game would be over. They needed a way to make billions of dollars of debt vanish just for one day, the day they took the snapshot. They didn't fix the problem. They decided to hide it. This is where the story shifts from bad management to criminal intent. They used a mechanism called Repo 105. It sounds technical, but it's actually a simple magic trick. Think of it like hiding your dirty laundry in the trunk of your car right before your mother comes to inspect your house. Here is the exact mechanism of the Lehman Brothers bankruptcy fraud. A few days before the quarterly report, Lehman would take $50 billion of toxic assets and sell them to another bank overnight. They used that cash to pay down their debt. Then the quarterly snapshot was taken. The balance sheet looked clean, the debt looked low, but here's the catch. It wasn't a real sale. They had a secret agreement to buy the assets back a few days later at a slightly higher price. They paid a fee to rent the cash, just long enough to fool the public photo. It was a $50 billion lie, executed quarter after quarter. Why go to this trouble? Because of the leverage ratio we saw earlier. If Lehman showed the world they were leveraged 31-1, the stock drops to zero instantly. They needed to look like they were at 12-1. So they used a loophole in London law that allowed them to classify this loan as a sale. It is the legal equivalent of crossing your fingers behind your back. They moved the debt across the ocean, took the photo, and moved it back. It was a magic trick performed to an audience of regulators who were looking the other way. For years, they claimed this was just standard accounting. But the Valukas report, this autopsy right here, proves they knew exactly what they were doing. Look at this internal email from the global financial controller, unredacted by investigators. He describes Repo 105 as another addiction we are feeding. They knew they were hooked on the deception. They knew the only way to keep the stock price up was to keep hiding the debt. This document is the smoking gun. This wasn't a market storm, it was a controlled demolition rigged with accounting explosives. And on Friday, September 12th, the timer on those explosives finally hit 0. To understand how fragile the system really was, you have to look at the final 48 hours. On Friday, Lehman's stock closed at $3.65. It was a disaster, but inside the boardroom there was a pulse. They had a deal on the table. Barclays, the massive British bank, was preparing to buy them. It was the bailout Fuld had been praying for. The executives at the New York Fed breathed a sigh of relief. Wall Street went home for the weekend believing the fire was out. They thought the system had held. They were wrong. Sunday morning, the deal was done. The lawyers were drafting the papers. Then the phone rang at the Federal Reserve. It was the British regulators. They didn't just say no, they slammed the door. The British Financial Services Authority refused to approve the transaction. Their reasoning was brutal and precise. They would not import America's cancer into the British banking system. In 1 second, the deal evaporated. There was no plan B. There was no government bailout coming. The room went silent. For the first time in history, the Federal Reserve had run out of ammunition. The clock had hit 0. At 1:45 a.m. on Monday, Lehman Brothers filed for Chapter 11 bankruptcy. It was the largest filing in the history of the United States. When the sun came up, the world saw the image that defined the era. Thousands of bankers walking onto the street, carrying their lives in cardboard boxes. If you ask what happened to Lehman Brothers employees, the answer is they were the first casualties of a war they didn't know they were fighting. The Dow dropped 500 points, but the real damage was invisible. The credit markets, the plumbing of the global economy, simply froze. Banks stopped trusting each other. Ships stopped moving. The weapon had gone off, and the shrapnel hit every bank account on Earth. You might think the dust has settled, but look at this chart. The exact same bomb is ticking again. Now, we have to look in the mirror. Because while everyone is still traumatized by the housing market crash 2008, they are looking in the wrong direction. The toxic asset today isn't your house. It is your office. During the pandemic, the tenants left the buildings, but the debt stayed attached to the concrete. We are staring at ghost towers in every major city. Walk down Market Street in San Francisco or Midtown Manhattan. The lights are on, but nobody is home. They look valuable from the outside, just like those subprime mortgages looked valuable on paper. But inside, they are hollow. And just like 2008, the banks are holding the bag. I want to show you the scariest chart in the world. This is the curve that broke the economy in 2008. Now look at this. This red line is the commercial real estate vacancy rate right now. It is hit 19.8%, a historic high. It is tracking the 2008 collapse almost pixel for pixel. In banking, we call this a wall of maturity. $1.2 trillion in loans are coming due, and the buildings aren't making enough rent to pay the interest. It is the exact same shape. It is the exact same math. The only difference is the collateral. So why hasn't it crashed yet? Because the banks are using a new magic trick. They call it extend and pretend. Instead of foreclosing on these bankrupt buildings and admitting the loss, the banks are just renewing the loans. They are pretending the building is still worth what it was in 2019, so they don't have to mark down their own equity. Does that sound familiar? It should. It is Repo 105 all over again. They are hiding the debt to buy time, hoping you won't notice the rot before they can exit the trade. They are stalling for time so they can exit the burning building before you smell the smoke. So how do you get out first? You don't need a crystal ball. You need the survivor's manual. But before we open it, a warning. I am decoding the mechanics of the crash, not managing your portfolio. History gives us the map, but you have to steer your own ship. This is analysis, not financial advice. We have traced the ink from the 2008 Valukas report directly to the empty skyscrapers of 2026. The bank died, but the mechanism survived. They are counting on the complexity of the fraud to keep you paralyzed, but you now have the decoder ring. The 2008 survivors followed 3 protocols. First, liquidity. In a credit freeze, cash isn't money, it is oxygen. Second, zero leverage. Debt is a noose that tightens when assets drop. Third, tangible assets. While paper wealth dissolved, physical ownership held its ground. The Valukas report was hidden for a reason. We are building an archive of the files they don't want you to remember. If you want to be in the room when we open the next cold case, you need to subscribe. Now, put your verdict on the record. Look at the 2026 data. Do you trust the banks to manage this soft landing? Yes or no? Leave your answer in the comments. Stay sharp.